This is the current federal tax developments for the week of October the 9th, 2017. Current federal tax developments, as always, is brought to you by your state CPA societies and by the Loscalzo Institute of Kaplan Company. This week, what we're going to look at includes South Dakota gets its chance to petition the Supreme Court and has sent it in regarding its challenge to Quill. Congress ended up passing a tax bill, not the one we were talking about last week, but one nevertheless that will provide hurricane relief. We'll talk about what it means to willfully fail to file an FBAR report and whether a taxpayer met that standard. We'll take a look at parents who got a nasty surprise about the dependent son and with regard to what ended up happening when we looked at whether when the son had gone to get health insurance. The Large Business International Division of the IRS announced a method that can be used in order to use your accounting system as a starting point, your GAAP compliant accounting system, as a starting point for qualified research expenditures. We'll talk about time off donation programs being expanded to cover Hurricane Maria relief donations. And we'll also discover the IRS has released their updated special per diem rates for the new fiscal year. Now, we do have an event coming up that a lot of your state societies participate in and wanted to mention it. We have webcasts coming with Don Cochran here at the end, toward the end of this month on October the 23rd and 24th. Now, many of your state societies, along with the California Society of CPAs, participate in Cal CPA's webcast program. And that means you can sign up, get your state society discounts, and participate in these programs. They start at 8:30 a.m. Pacific Daylight Time. Now, on October the 23rd, Don will be giving a session on the introduction to international taxation. On October the 24th, he'll be talking about construction contractors, special tax, and accounting considerations. So these are those programs that, of course, with being a webcast, you take it from the comfort of your office or your home, whichever you prefer. You can sign up, as I say, go to your state society website. Many of our state societies participate in these programs with Cal CPA. So you go to your local society website, you'll be able to get your discounts there and sign up for the programs. You also can go to Cal CPA's site itself to sign up for it. And obviously, if you are a Cal CPA member, that's where you want to go. International taxation is interesting because, I don't know, some of you may have some work to do in that area. It's always an interesting course to try to put on to get enough people in any single state to attend it. So this way we can take a look at having a lot of people get involved so everybody can get their coverage. And a lot of us have construction contractors, and with the new revenue recognition programs and with all of the tax mess that goes with construction contractors, not a bad way to spend time. So again, the 23rd and 24th, go ahead and check on your state society website to go ahead and do the sign up. Let's start first with an update on an issue we talked about a couple weeks ago. That is South Dakota's case involving the state of South Dakota versus Wayfair. And that was one that was decided on the 14th of September. But now the state of South Dakota, as they had told us right after the decision came down, has filed the appeal to the U.S. Supreme Court. The South Dakota Supreme Court had ruled that, in fact, the state of South Dakota could not collect sales or force Wayfair and two other taxpayers who had no physical nexus in the state of South Dakota to collect sales tax. That was kind of the decision that the state of South Dakota wanted, because the whole purpose of enacting this law was to get it before the U.S. Supreme Court to, from South Dakota's perspective, hopefully get Quill decision overturned. In fact, in their petition, there's an interesting phrase in there that simply tells us, and this probably summarizes the whole petition, even though it goes on for about 70 pages, that simply says Quill clearly needs to go, and that is South Dakota's position. We're asking the U.S. Supreme Court to hear a direct challenge to Quill in this case. Quill, you may remember, it was Quill versus the state of North Dakota, goes back many years now. And Quill versus North Dakota held that you could not force a taxpayer to collect your sales or use tax if the taxpayer did not have substantial nexus in your state and generally had to have some form of physical presence in your state. The state of South Dakota now believes that is outdated, wants it overturned. They do have one advantage. Two justices sitting on the U.S. Supreme Court currently have both commented on this on a case we talked about before, which was Direct Marketing Association versus Brohl, which was the case that eventually held that Colorado's tattletale program, where you have to turn in your customers, was not a violation of the Constitution. And Justice Kennedy, in writing a concurring opinion in a Supreme Court decision that was on an initial pass of the case that dealt with jurisdiction, made a comment that he felt effectively it was time to review Quill. When the actual case, the final decision, the one that ends up holding, because the Supreme Court did not agree to hear an appeal of this decision, when the 10th Circuit's opinion came down that is the final decision, a concurring opinion in that case was written basically that told us that we have a, that Quill was something that probably was outdated, didn't really matter in this case. The judge that wrote that sat on the 10th Circuit, and the judge was Neil Gorsuch. Neil Gorsuch, you may remember, since he penned that particular concurring opinion, was nominated for and confirmed by the U.S. Senate to the United States Supreme Court. So we have two justices that apparently are okay with doing something to Quill. We'll have to see whether or not the other 7, by the way, Supreme Court hates tax cases normally, whether in fact enough of the other 7, they need 3 more to come along, would agree to hear this case, or whether the Supreme Court's going to punt on it again. So keep your eyes open, but South Dakota now has gotten to where South Dakota wants to be. They have their petition before the U.S. Supreme Court. Next up, Congress really did pass a tax bill this year. You might have thought it wasn't going to happen, but it did. The catch, of course, is the tax bill they passed is not the comprehensive reform bill, which is the one we're all waiting for, but it is a bill made necessary by the 3 hurricanes. And unfortunately, this weekend, as we record this, we'll release this, and some of you will be listening to this in the week, beginning Monday, its release date. And by then, apparently, we will have had a 4th hurricane make landfall in the U.S. But we have the hurricanes, the Disaster Tax Relief and Airport and Airway Extension Act of 2017. That was signed into law by President Trump on September the 29th. This bill adds a number of special provisions to grant hurricane relief. Most of the provisions are limited to individuals living in areas that are specifically impacted by one of the 3 hurricanes. However, there is one provision for charitable contributions that actually applies to any U.S. taxpayer. First, let's talk about what impacts qualified retirement plans. And there are really 3 different rules here. First, we establish qualified hurricane distributions that can be made from qualified plans or IRAs. That allows a participant to essentially take $100,000 out of the qualified plan or IRA. It is considered a qualified hurricane distribution. Now, obviously, you must be in one of the affected areas, and you have to go to the websites to make sure that you qualify under that requirement for affected areas. You will be able to avoid tax on the distribution as long as the amount is repaid to the plan within 3 years. The payment, even though it is now open for withholding under a 3-year rather than 60-day rollover issue, so let's say it's open to rollover, we are not required to have a 20% withholding on that, as is normally true for rollover distributions from qualified plans where you get a check. Basically, and for IRAs, the same rule applies, except there will be treated as a trustee-to-trustee transfer. Why is that important in IRA? Because it means it won't cause us a problem with the one rollover per year rule, regardless of when we put this money back in. So again, up to $100,000, what's essentially they're saying they're allowing you what's effectively a short-term interest-free loan to be taken from the plan. It's not really a loan, but for all practical purposes, as long as you get that $100,000 back in within 3 years, you're deemed to have a non-taxable distribution. So that's good news if you can do that. Also, some people may have taken distributions out to purchase a home under one of the exceptions that allow you the first-time homebuyer exception. Well, if you took it out under the special provisions related to buying a home, that's under Section 401(k)(2)(b)(i)(iv). How's that for a nice deep one? Section 403(b) 7 cap A double I, and only to the extent such a distribution related to a financial hardship for that one. 403(b) 11 cap B, or Section 72T2F. The latter one is the IRA first-time homebuyer rule. After February 28th of 2017 and before September 21st of 2017. You plan to use it to purchase or construct a residence in the affected area, but you ended up not going through with the purchase due to the hurricane. Perhaps a house that you were planning to buy was essentially, destroyed in the hurricane or destroyed by flooding. So you're not going to purchase the home. You can now put that money back in, essentially, and you'll be able to put those funds back in, essentially from the period from August 23rd of this year through February 28th of next year. This doesn't give you a 3 years, obviously. This money has to go back in quicker because the idea is you're not buying the home. The theory being, of course, well, if you're not using it to buy the home, then we're not just going to let you hold the money out there. You have to put that money back in. We also are allowed liberalized plan loan rules. We're going to increase the maximum borrowing to $100,000 from $50,000. That'll be useful. And the maximum percentage of vested interest goes from 100% to 50% temporarily. They have to be made after the qualified beginning date. That depends on when the hurricane hit your area. So each one has a different start date. And before December 1st, 2018, that is the end of next year. And the due date is delayed by 1 year for those qualified plan loans. The law also allows, because plans are going to need to be amended to provide for this, they allow for an extended amendment relief until a date the IRS specifies for these amendments. You have to operate the plan as if it was amended. We then also add another new provision to the law. We add an employee retention credit. If you were located in an affected area and you had to shut down for 1 or more days due to the hurricane, and you decided to pay employees during that period, even though you weren't open for business, you're allowed a credit of 40% of the wages paid, capped at $6,000 per employee, so a maximum credit $2,400 per employee. Now, they had to have been working for you there before the hurricane. You can't just add people on later. Right, and it has to be those. Now, the employer has to be the employee of an employer whose principal place of employment when the hurricane hit was with that particular employer. And you had to pay him while the business was inoperable. You can't go back now and retroactively push that through. Congress also provided, this does affect everybody, the charitable contribution limits are temporarily raised. If you make a contribution for hurricane relief for any of the three, and unfortunately, as I sit here today, you have to expect at some point we may add for 4 hurricane areas, the limitation will be increased to 100% of income for qualified contributions. And that'll be true both for individuals and for C corporations. So your C corp no longer be 10%, you can do 100%. The contribution has to be paid after August 23rd of this year and before December 31st in cash only, no contributions of goods to the organization. Has to be made for the relief efforts for the 3 hurricanes. We'll see if a 4th one gets added. And you have to obtain from an organization a contemporaneous written acknowledgement, which you always have to have for the contribution anyway, but it needs to specify that it's being used for qualified hurricane relief efforts, and you have to elect the application of the section. There is an anti-abuse provision. You cannot use this for contributions made to a private foundation or for the establishment of a new or the maintenance of an existing donor-advised fund. So we shut that particular one down. Special rules are also added for casualty losses. Okay, we got everything in here. So the 10% floor is removed, but the $100 floor is raised to $500. Remember, we have those dual floors. You had to clear 10% of your income plus 100. Now it's like you don't have 10%, but you got to clear 500. If you have a casualty loss related to damage from one of the hurricanes, and also, by the way, you don't need to itemize. If you don't elect, in essence, your standard deduction will be increased by this amount if you don't elect to itemize. So even non-itemizers can take advantage of this, or people who otherwise couldn't itemize, they'll be able to get full benefit. Finally, one other special rule is there is a special rule for determining earned income. Any individuals in the affected areas for computing the refundable child tax credit and the earned income credit, they'll be allowed for those computations only to elect to use either if their earned income went down in 2017 from 2016, they'll be allowed to use, presumably it's going down because where they worked was destroyed, shut down for a month or 2 months, 3 months, whatever it may be. they'll be allowed to elect either the 16 or 17 amount of earned income and use that for calculating those two credits. You'll still use the real income for everything else, but for purposes of the earned income credit and for purposes of refundable child tax credit, you can use whichever one of the two gets you the greatest credit. Okay, so that's it for our hurricane bill. Again, a few provisions generally limited to people in the hurricane area, but the charitable contribution one is open to everybody if you want to go over the 50% limit. Next up, we're going to talk about FBAR reporting. This is the case of Bedrosian versus United States. It was from the Eastern District Court, the U.S. District Court for the Eastern District of Pennsylvania. Case number 2:15-CV-05853. Decision was issued on September 20th. Now, the taxpayer lost his first argument. The question was, what's the proper test for determining if you willfully failed to file your FBAR report? The taxpayer tried to argue that the test should be the same as for a criminal indictment area, where you had to basically have bad intent, criminal intent, to file, to fail to file. You had to have some bad intent. The district court here agreed with other courts that have heard it so far that the test rather is a lower level of merely knowingly or recklessly failing to file the form. So you might not have necessarily known that you should have filed the form, but you might have just recklessly disregarded your obligations about what needed to be done about that account in Switzerland. Okay, so they lost on that, but the taxpayer in this case won ultimately on the question of whether they had essentially willfully not filed their 2006 FBAR report or had filed it improperly, right? The issue at trial, basically, the court admitted that all the way through 2006, this taxpayer had accounts in Switzerland. He had originally set them up there because he traveled a lot in Europe and he just needed them for basically convenience. But ultimately, he started using them for more things. Now, apparently, he didn't tell his accountant about this, and so the accountant didn't know they were there. Eventually, he did tell his accountant about these things, and the accountant effectively, after being told, said, well, you've been breaking the law all along. So essentially, we really can't do much about this, because you've been breaking it all along. So I would advise you, because you've been going all these years, not reporting the income, not filing your FBARs, I'm advising you to not file them now. Suffice it to say, that's not great advice. But however we look at this, it nevertheless was advice he operated under. Now, the court made it pretty clear, and I'm pretty sure the taxpayer wouldn't have gotten out of this if the story had stopped there. The taxpayer indicated, the court said pretty clearly the taxpayer was aware it was illegal. The taxpayer knowingly took the risk of not reporting it up through that point. But he eventually became aware that this was more serious, and his old CPA died. So in 2007, after he did that, after his old CPA died, he went to somebody else who said, Guy, you really need to report the FBAR. Now, the problem that came up was it turns out that he had two accounts with UBS. And he apparently wasn't totally aware there were two. So he told the accountant about one, and he always considered them one account, even though UBS would tell him it was two. He had told UBS not to send him paper forms, so it was always communicated orally or otherwise. That's kind of interesting. But the other neat thing was he started to file these forms, even though the IRS did actually have the information from UBS by that point. They had not actually started investigating him yet, and he wasn't aware they had it. So he did start filing. So the real issue, which is kind of weird in this case, was whether his omission of the second account on his 2007 FBAR represented a willful failure to file the FBAR form, properly willful failure to report that account. And what the court decided was that it didn't qualify as willful, right? Even though he, had those issues, even though he had failed to report, this wasn't willful. He had a real misunderstanding of what the case was. He was trying to report. And the court found, IRS, you haven't proved that he knowingly or recklessly failed to properly file the forms. Now, to be totally honest, I read this as a relatively close case. And, the fact he did or didn't know about that second account appears to be teetering on the brink. And the fact that he also had been told it was illegal, but kept not reporting it, even though he was advised, quote unquote, not to, still would probably have been iffy. I think what really saved him was the fact that obviously he started reporting prior to the time the IRS contacted him, and at a time when he had no idea they had the information. So it was one of those things where, he probably got by the skin of his teeth, not being nailed with the willful failure, which, by the way, gets very nasty in terms of the penalty. Next up, let's go on to another case. This one turns out it can be dangerous to claim a dependent on your return. This was the case of Gibson versus Commissioner, Tax Court Memorandum Decision 2017-187 that came down on September the 25th. What happened in this case, it appears we have an adult child who nevertheless was qualified, apparently could qualify as their dependent. We don't go into all the details about why it would qualify. Was he a full-time student? Was his earnings below the limits? But he could qualify. He qualified. Now, apparently the child sometime during the year had gone to the exchange and had obtained coverage for free. He told him his income, which was essentially next to nothing. And so it was determined that he qualified for a full payment of the premium for the silver plan. And so he essentially got free coverage. Well, he apparently never told mom and dad about this, and he even didn't seem to be aware of what it was. He kind of forgot about it. I'm sure the idea may very well have been that somebody told him, no, you want to go sign up for this because, with your income, it's free. You just need to go sign up. So he did. So he ends up with this free coverage. Well, the catch in this case is he ends up having paid $4,628.80 worth of premiums, were all paid by advance credits. That's a problem because he ends up on mom and dad's return. Mom and dad have him on there as a dependent. Mom and dad's income is way higher than could ever qualify for a subsidy on the exchange. So what happens is mom and dad file the return. Now the IRS comes back and says, oh, mom and dad, by the way, we have a 1098-T that relates to your son. And it says that he got a prepayment of $4,628.80. Well, mom and dad tried to claim, they asked the son, he claimed he had no coverage. Well, problem was, it was pretty clear from the exchange information that he had coverage. And he also had claimed he was covered by his employer. But once you took a look at that part of the record, you discovered that coverage didn't start till basically the very end of the year in question. So that wasn't his coverage. And so he thought he had coverage. He just didn't realize where from. He may have knew he had it. So I assume he was paying with an insurance card. He just wasn't aware that it was I shouldn't say wasn't aware. He should have been aware, we could say, but he wasn't aware it was an exchange card. So the problem the court found was, even though the court agreed mom and dad weren't aware of the issue, and mom and dad, really had no reason to know of the issue, nevertheless, there was $4,628.80 worth of premiums paid that there was a credit. And mom and dad, since that was their dependent, mom and dad owed the money back. Yeah, risky little issue here on that for the dependent. Next up, let's talk about the Large Business and International Division of the IRS. Issued a memorandum that allows you to use your ASC 730. My slide's wrong. If you're looking at the video portion, it says 750. Should be 730. ASC 730 reporting for qualified research and expenditures. Now remember, that's of course our accounting standards codification. This is the GAAP method for recording research expenditures. What the Large Business International Division has done is provided worksheets and an optional method for large taxpayers. It's important to understand it's a limited group that can use this, to use their ASC 730 research expenditures as the starting point. ASC 730 research and development expenses. Now, in order to qualify for this, you have to meet minimum qualifications. Those qualifications includes you must have assets greater than $10 million, greater than or equal to 10 million. Essentially, has to be your exam be conducted by the Large Business International Division. You must follow U.S. GAAP for financial reporting purposes. So if you're using IFRS, tough luck. You must have obtained an audit report on a GAAP financial statement that is either a clean opinion, a subject to opinion that does not involve anything with ASC 730, an except for opinion that covers a method of accounting the outside auditor disagrees with that does not involve ASC 730, or an adverse opinion that's not related to ASC 730, but an adverse opinion, the auditor has to disclose the amount of disagreement with the statement. IRS idea there is, well, there's something wrong here, so tell us what else is wrong so we know where to go look. The financial statement must report either as a line item or in disclosure of financial statements the amount of 730 expenses. So they want to see it in the financial because the theory of the IRS is they want to have a number on there that the auditor now had some obligation to specifically look at and verify as part of the financial statement. The amount of the qualified research expenditures will be determined by starting with these 730 expenses and then using adjustments per the adjustments found in the Appendix C worksheet in the memorandum. The resulting number is going to be called the adjusted ASC 730 financial statement R&D. Now you want to get this memorandum. We have a link to it on the website. We also have a link to it in this week's materials. It will give you all the statements you'll file as part of this. There are basically 4 statements that go with this. Okay, so you have to go with this. You'll have a certification that gives certain information that's found in Appendix A and also in our materials. Then you also have Appendix B to reconcile your qualified research expenditures from Form 67 65 to the ASC numbers. You'll have an Appendix C, the computation of the adjusted ASC 730 financial statement R&D in detail. And also Appendix D is the adjusted ASC financial statement R&D wage detail information to be provided. Now you don't have to use this, but you can. If you want to use it, you really should provide, you have to provide it with the exam, or with, I should say, with your return. However, they did say that when an exam starts for a qualified taxpayer, in essence, the taxpayer could at that point choose to let this method be used. And there are some information you have to make available to the auditor: the audited statement, your chart of accounts, the list of ASC 730 financial statement cost centers that make up the ASC 730 financial statement R&D, all the ASC 730 R&D GL account balance details that make up that financial statement R&D, and a list of ASC 730 R&D accounts with account balances that make up the adjustments that you're computing, your organization chart showing employees and level of management for the credit year, executed contracts pursuant to which you're performing ASC 730 research, executed contracts to which persons other than employees of taxpayers are performing that research on behalf of the taxpayers. Also, we can figure out, too, how much was done outside the U.S., and a list of employees or expected W-2 wage amounts that are claimed as additions to U.S. ASC 730 financial statement R&D. Okay. If you do that, LB&I examiners will not challenge QREs, which are adjusted ASC 730 financial statement R&D costs during the year. Okay. So it's an option you can use. Okay. So if you are a large taxpayer, it's something you might consider. Next up, quick note here. Not surprisingly, in Notice 2017-62, the IRS added Hurricane Maria to the areas for which an employer can set up a leave-based donation program, right? So the terms are the same as for Harvey and Irma relief. Also, finally here, quick issue, the IRS has issued the special per diem rates for the new fiscal year. This was found in Notice 2017-54, issued on September the 25th. The transportation industry rate, now beginning on October 1st of 17, is $63 inside the continental United States, $68 per day outside. The incidentals portion, if for whatever reason, you're getting actual meals, actual hotels, but you're not reimbursing for any other items, the incidentals, that's $5 per day if you're using that method. If you don't actually go with where somebody goes in detail, look up the detailed rate, but you just want to have the 2 rates of reimbursement, high, low. If they're in a high cost area this year, the high rate will be $284 per day. That's combined lodging and meals and entertainment. And the low, I should say lodging and meals, not lodging, meals, and entertainment. And the lodging and meals rates in low rate areas will be $191. Again, Both of these were effective on October 1st. Well, we're getting to the end of the year here again, getting into the end of tax season, and we're on the final push. Once you come up for air after you finish here, remember to go check your state society's catalog, find the courses you want to have through the end of the year before we start the whole process over again in the beginning of 2018. So it's CPE time to get things up and running. This has been the current federal tax developments for the week of October 9th, 2017. You can catch our updates regularly throughout the week on our website, currentfederaltaxdevelopments.com. You can also download a PDF that has the articles with all of today's topics. And you can send your questions and comments to me, Ed Zollars at currentfederaltaxdevelopments.com, or you can follow me on Twitter. You can find me there at Ed Zollars. Well, we look forward maybe late getting it out next week, honestly, just because I've got deadlines somebody else does to get clients out of here. So we'll see how it goes next week, and if everything comes out on time, I can get all the materials together and get it all recorded. I hope to get it done next week, same time, but if we come out a couple days late next week, hopefully you understand why that's happening. So keep an eye on that. But otherwise, hope to see you next week as we'll talk about what's happening here with new developments in the area of federal taxes.